welcome. You tune into Markets at Noon with me, Ankita Saxena, and with me is Ashesha Adwariyu for the next 1 hour. We'll take you through what's transpiring in the market, and as of now, there's a lot of primary action that's coming in. Ashesha, we have Orkla that has IPO today, that has hit the bourses. It has listed at a debut of 3% premium, very muted start, and the share has already slid 7% in trade after its listing. But tell you what, we have the management. Sanjay Sharma, MD and CEO of Orkla India, is now joining us. Hello, Mr. Sharma. Thank you so much for taking the time out and joining us today. Tell us, what are your key focus areas post the listing? Will the growth be driven more by category expansion, distribution deepening, or international markets?
It's been a great day. It's been a momentous occasion for us. I think when we entered India in 2007, that was really just the start of our journey. And I think we are now today at a place where we are listing this wonderful company that we have created over the last 18 years of our presence in India. Now, going ahead, I think I strongly believe that we have a long growth runway ahead of us. I think on the short term, you can see that there is a lot of positivity which the government has infused into the environment. The consumption levels will hopefully get stimulated with the whole host of initiatives that the government have taken, and I think we will start to see that consumption will improve. You have already started seeing a little bit of that featuring in the results of the other FMCG companies. For us, Q1, we delivered a 8% growth, and I think with that perspective, we are going to continue to go ahead. From a long-term perspective, I think India is doing very well. Our GDP we continue to be the world's fastest growing GDP, and our brands, our brands have got very strong local positions, and we will continue to focus on that and build. The key things that will drive our long-term growth is really going to be the conversion from unorganized sector to the organized sector. I think that is one big change that will happen.
Understood. So from unorganized to organized sector, we are expecting a shift, and that is expected to aid growth for the company. Mr. Sharma, afternoon. Ashesha this side. Also wanted your thoughts on the PAT drop that we have seen after 2023, but that has been recovering over the last few quarters. What is your medium-term outlook when it comes to profitability and margins, and are you expecting substantial improvement in the next 2 quarters?
Yeah, I think when you look at the long-term potential of our business and the long-term performance of our business, we've always reflected a strong double-digit growth performance. In the short term, as you rightly said, that we've seen a little bit of, at least the numbers show a little bit of a drop in PAT. I think if you go into the details of those numbers and you look, you'll see that there are one-time tax effects to the tune of 150 crores in 2023 that we got on account of the merger that came into effect of Eastern with MTR. So I think the right indicator to look, if you take out the tax effects on the profit, is the PBT. And when you look at the PBT development over the last 3 years, you will see that we have delivered a 17.6% PBT growth. Also on an absolute margin level basis, if you look at it, we are our FY25 results reflect a margin of about 16.6%, and then the Q1 margins have also continued to hold up at about 18.2%. So I think from a margin space, I think we are sitting on a very strong margin platform at this point of time.
Right. Also tell us, with the GST reduction on the premixes, how are you viewing the demand? Any major changes there?
I think the GST cut has just come in recently. Let me tell you that already 75% of our portfolio was already at 5% GST. Now the remaining 25% portfolio is now come from 18 and 12% GST levels to about 5% GST levels. As mandated by the government, the effects have come into place from 22nd of September, and we have passed on a reduction in prices to our consumers thereof. I think it's very early stages at this point of time to reflect on what is going to really happen in terms of an uptake of consumption. But in my mind, I think, and I take inspiration from what was said by the Prime Minister, that there has been 250,000 crores of consumption of money that has got released for consumption. I think we will let the consumers decide in terms of how that consumption money is going to be spent. But I think we are sitting in an optimistic note at this point of time to see a development that will be positive for the entire FMCG industry and the food industry.
All right, so GST reduction on premixes is likely to aid growth going forward. But Mr. Sharma, also throw some light on your Capex priorities that you have over the next 12 to 18 months. And are you planning capacity expansion or new manufacturing facilities anywhere across India?
Well, if you look at our RHP, you will actually see that we have 9 factories, and our capacity utilization is just at about 46%. So, in fact, given this kind of a state, we are at our number one priority is to improve the utilization of our plants. So, I think our focus is going to be about driving the usage of our plants. Of course, in the next short term, we may require some level of Capex, not more than 20 to 30 crores every year. And these are Capexes which are required largely to do line balancing and doing food safety kind of measures. Having said that, our focus with these 9 factories and with such a low capacity utilization that we are having today, our focus is only to improve and build a manufacturing system which is highly efficient. And for that, we are actually taking a whole series of initiatives, like we are rationalizing our factories, we are looking at building large, high-quality plants, digitizing our factories so that we are able to measure every activity that takes place in our plants and improve, places where we are either losing time or losing quantity of production, thereby improving the productivity, as well as we are looking at outsourcing certain low value added products which are become very costly when they are produced in our plants. So to be competitive, we are looking at moving some of these products out as well.